Well, good morning and welcome to the Plato Global and Australian Income Webinar on reporting season and will the dividend bonanza continue for income investors. My name is Mark Cormack and I'm a Director with Pennell Investment. Pennell are equity partners and work alongside Plato to distribute Plato's Australian and global income funds to the financial advisory marketplace. And today I'm delighted to be joined by Dr. Don Hamson, Plato's Managing Director, and Dan Pennell, Plato's Global Portfolio Manager. For our webinar today, we're going to provide an update on income-generating assets from around the world, discuss why there has been a dividend bonanza here in Australia with Plato delivering over 16% gross income in the last financial year. And then we'll also provide an update on how global equity income has been looking. As a bit of background, Plato specifically manages high-income solutions for low-tax investors such as retirees. And this is different from most fund managers who manage money for clients in all different tax brackets, making it hard to optimise income and total return. And this especially if you don't know who the end investor is in terms of their tax status. And because CGT is no impediment for low tax investors, Plato can actively rotate through dividends to deliver their high income solutions. Before we kick off today's webinar, a couple of housekeeping items before we start. Presentation will last around 15 to 20 minutes and that'll be followed by a Q&A session. All attendees have the opportunity to ask questions via the internet. This can be done by clicking the questions tab on your screen. So without further ado, I'll hand it over to Dr. Don Hamson and Dan Pennell for today's presentation. Thanks, guys.
Thank you, Mark, and welcome listeners. So the RBA set some fairly gloomy background or backdrop for reporting season. We've had two interest rate cuts in June and July to move Australian interest rates to cash rates to their lowest ever at 1%, and the market's actually forecasting another two cuts is basically fully factored in over the next 12 months. And indeed, at least one group, Deutsche Bank, have called for interest rates to fall to 25 basis points over the next 12 months. At the same time, Commonwealth bond yields actually have now, they didn't drop until July, but August, but they've now dropped into sub 1% territory. In fact, the latest read's about 0.93%. So you can currently buy a 10-year government bond on an interest rate of 0.93% yield to maturity, which is less than the inflation rate. So that suggests a very, very weak economy. So it set the tone for a soft reporting season. Problem for retirees and people living off their investments is that the lowest ever cash rates, the lowest ever bond yields in Australia makes it very hard for people to fund their retirement or fund their living from investments in typical income products such as cash, term deposits, bonds, or even income securities, because anything linked to cash or bank bills, their rates have fallen significantly already this year. So those record low interest rates pushed the market to a high just preceding the reporting season. But as I sort of mentioned, I mean, basically this wasn't suggesting good reporting season, it was suggesting a poor reporting season. And it was, I think, simply the fact that rates are at an all-time high, low, which pushed the market to an all-time high. Because low discount rates means that you should, whether it be bonds, whether it be houses, or whether it be equity markets, they should trade on higher prices. So it's a multiple expansion when interest rates go down. And indeed, we had some precursors to that. There were some early profit warnings really before the reporting season started proper from the likes of AMP and Adelaide Brighton. They were very poor results, and both of them actually emitted their dividends, which caused some pretty soft share price performance. And overall, the season was very soft, particularly the earnings numbers that came out. But they weren't as soft, I think, as the very low interest rates suggest. We're not in a recession. Earnings are still coming through. And indeed, as an overall number, the average dividend increase, we will focus a lot on dividends, was actually 9%. And the median increase, as we'll see in a minute, was 3%. So those are still pretty good numbers. And in fact, if anything, dividends probably surprised on the upside. Turning to some of the numbers now, in terms of dividend increases, about 53% of companies that we follow that reported in August increased their dividends. 23% maintained them on a cash basis, while 19% maintained them on a gross dividend basis. And then there were the decreases were around, this includes emissions, around 23% on a cash basis and 28%. So there were certainly a lot more rises than falls. And if we look at the average changes from the year to year, so this is where we're comparing dividends that were announced in August this year in the reporting season, and we compare them to the dividends that were announced last August. So for most companies, that would be the final dividend paid for the year, but for December year-end companies, it will be their interim. The average cash dividend, as I've already mentioned, increased year on year by 9%. But if we look at the median, which is probably a better number because it does actually it gets rid of the outliers, and there were a few large dividend increases. There were also a couple of large dividend falls. But so for the median, it's probably a better overall picture, and it was only up 3%. But still, it's still up year on year, whereas we see that income from cash and bonds is actually down significantly. On a gross basis, those are 8 and 2. Now, it is, though, a substantial reduction in the pace of change from February. February, the average dividend increase was 22% when we did the webinar in early March, and the median increase was 5%. So we have seen a slowing in the growth in dividends, but I think there are a couple of factors there. The first one, or certainly one that's significant and people should take advantage of, acknowledge, is that in February and in last year, we were all very fearful that the ALP may change the franking rules, and a number of companies such as Flight Centre, Woodside, Wesfarmers, and even our own LIC, PL8, got ahead of the game by actually increasing dividends last year, or in February, or in the first half of calendar 2019. There was a number of companies that increased dividends to get ahead of the ALP policy if it were to come in. And so I think that nudged those numbers up, but we did see some very, very strong increases from the resource stocks. And whilst we've still seen strong increases from resource stocks, they have slowed down a little bit. Another feature, another interesting thing there was a somewhat surprising buyback announced by Qantas, and Qantas also increased its final dividend by 30%. Which is a little bit against the grain because its earnings fell about 17%, but its underlying cash flow was strong. It has excess capital. And importantly, I think the reason why it was able to buy back shares with an off-market buyback, which is tax effective, is because Qantas is paying some good tax and has good franking credits to distribute. So Qantas announced a $400 million off-market buyback. It's about 4% of shares on issue. We estimate that will be worth about 14% for pensioners. We've actually written a separate note that's on our website. We would suggest there'll be a fair bit of scale back. But this sort of transaction, an off-market buyback, I mean, we estimate that's worth around 14% for tax-exempt investors. The reason being that you get a fairly large fully franked dividend. We estimate based on the price at the 30th of August that the fully franked dividend will be about $4. You get a big franking credit with that. Plus you get a bit of capital, and so you get something like a tax-exempt investor like a pension trade super fund would get around $7 by tendering into the buyback versus $6.11 was the closing price in August. Now that is the August price. The actual buyback price will be based on the week before the buyback concludes. So you need to keep sort of updating your analysis, but you could, if you like, look at our analysis on the web. But we expect to participate in that Qantas buyback. Other highlights and lowlights of the reporting season. Firstly, highlights. We still saw some strong increases in dividends from BHP, Fortescue and Rio. We saw record iron ore prices, certainly in the June quarter and through July. But we have seen actually that the iron ore prices have settled significantly, in fact dropped something like 25% in August. So perhaps we're actually at the top of the iron ore dividend cycle for these guys, but we'll still see pretty strong earnings in the first quarter for Rio, BHP and Fortescue. Rio paid a $1 billion special, and Fortescue actually, given that it also paid 2 specials, it doubled its final dividend plus the 2 specials plus an increased interim, it actually had absolute record dividends for the year and currently trades on a trailing yield of about a 20% gross dividend. I would say that's probably about the top of the cycle there, but other good dividend increases, 300% by independents. A number of the gold stocks increased their dividends between 40 and 50%. Amcor increased by 100%. And not a huge lift, but JB Hi-Fi defied all the expectations that the retail, the consumer's dead and the retail market's incredibly hard. They actually surprised the market with better than expected earnings and lifted their final dividend by 11%, and they performed pretty strongly. And the honourable mention, even though they were hit by $614 million of increased fuel costs, was Qantas with its increased dividend and buyback. The lowlights, we've already mentioned AMP and Adelaide Brighton pre-releasing poor results and omitting their dividends, and Speedcast pretty much did the same thing. It came out with a pretty ordinary result and completely omitted its dividend, and on the stocks we follow was the worst stock for August. There were fairly big cuts from the likes of Alumina, Blackmores, Caltex, Saluka, South 32, and Santa Barbara. Santa Barbara is a gold mining stock. It defied the other stocks because it had some mine-specific issues there. So that's pretty much it. It was still a reasonably good dividend period. Earnings were a bit soft, and clearly the Australian economy is going into a slower patch, but we don't believe it's going to go into a full-blown recession, but it will be a soft sort of next half. I'll now turn over to Daniel to talk about global trends.
Thanks, Don. Now we're going to switch to global income, and I'm just going to outline some of the main trends in the market and then highlight some of the drivers behind those themes before briefly providing our outlook at Plato for the global income market. So as some of you know, we've been researching investing in the global income space now for some years, and last year we started producing a quarterly newsletter just to try and help our client base understand what can be a pretty complex environment. Investors often feel there's no income in global shares and often can feel uncomfortable with global exposures. But the idea behind this newsletter is just to highlight those trends and drivers and to help put a little bit of colour and increase the understanding of global income for our investors. And as you can see on this slide, these are available on our website for the last few quarters. So what are the trends? Well, firstly, you can see the growth in dollars both domestically and globally. And they've both been strong. You see the light blue line for domestic, but focusing on global, it's grown 7% to nearly 680 billion Aussie dollars in Q2. And that built on really strong growth in Q1 of 19% as well. And it's been really consistently broad, with over 60% of dividend-paying companies increasing or initiating dividends. We look at quarters because it's a really interesting pattern that really yield investors need to know. And it's that Q2 is often the biggest dividend-paying quarter, and it's driven by a lot of those European stocks that pay their annual dividends around then. So just to kind of put some numbers around that, in Q2, Europe was over 40% of the yield, but it was only 12% in Q1. So you really see it being driven in Q2 by names like Nestle, the Swiss company Royal Dutch Shell, an oil and gas business, or some of the pharma companies in France and in Germany like Sanofi and Bayer. But despite this pattern, we've consistently delivered monthly distributions to our clients. It's interesting to look behind those numbers and see what's actually driving the trends. And at the country level, we've just put those largest trends up on that chart. And dividends actually rose in most developed countries, but some of the significant ones are 10 to 20% increases in large countries like Japan and like the US. As I mentioned, Europe does actually pay the lion's share of dollars in Q2, but there's also a little bit of weakness. You can see Belgium and Denmark there, and even a bit of a powerhouse in Europe. Germany was off 6 or 7% in its yield comparing Q2 with Q2 last year. If you think about recent low rates, economic concerns in Germany, they've been reflected in that fall in yield. An increasingly hostile trade war, weaker manufacturing, they've all contributed to that second economic contraction that we've seen in the last year. One really important thing to mention is currency, and it can often be overlooked, but the movement in the Aussie has a really significant impact on what a local investor actually receives. So growth was pretty strong in Q2, as I said, headline is 7%, but 4.5% of that was because of a weaker Aussie. So although that is important, it diversifies, it's actually income you get, the local dividend yield was only just over 2% when compared to the previous corresponding quarter. So we've said it many times, but avoiding dividend traps is really key. And at Plato, we've got a proprietary model that uses predictive factors to kind of forecast how likely we think it is that a company is going to cut its dividends. And you can see on that chart, there's been a really strong relationship in global between the predicted on the x-axis, so the likelihood we think of a company cutting, and then on the y-axis, the vertical axis, the actual amount that the dividends have been cut. And a good example is Debenhams. It's a UK store that had a nearly 50% chance of cutting in our model, and this was for the dividend at the end of last year in December. The price had fallen, yield was up over 15%, and we'd held it back in 2017, but stayed out because of that div cut probability, and it actually paid off. It had a big cut in December, went down to zero, and a significant price fall since. So an obvious question then is, what does it actually mean for the future? And what we do is we aggregate all of those dividend cut probabilities I just talked about, and then see what we think the likelihood is of the whole market cutting. And that's that blue line you can see on the chart on this slide. As it illustrates, we think there's a small chance, around 10%, of an actual cut. And if you compare that to back in the GFC when it's up over 35%, it's a lot lower chance now that we see dividends cutting. But it is worth noting, you can see that little increase at the end. We have seen a small increase in risk to global dividends over the last 12 months, and driven by some of those things we've talked about, political risks, the tariff war, falling rates, recession concerns, some of the issues in Europe. We have seen just a little bit of an increase in the chance that companies may actually cut at the overall level. This chart just simply shows how vast the opportunity set is for global. The red bars are the domestic dividends going X each month, just the number of stocks going X. And straight away you can see the blue, it absolutely dwarfs it. There's thousands of opportunities in the global universe. And I really just want to show two key things that this allows. The first is we can increase our rotation and offer extra active yield. And then secondly, we've been able to pay yield monthly, which has been really well received by our client base. So then the next obvious question is, what does that really mean for clients? What do they actually get at the end of the day? And the answer is simply consistent and substantial monthly income. On the left, you can see those light blue bars over the last few years, the 2% that broadly you expect from an allocation to global equity. And the first important point is that we've consistently delivered about 3 times that. We've been delivering over 6% now per annum since inception, and that's after fees and taxes, actual cash dividends to our clients. And then secondly, just on the right-hand chart, you can see just how consistent that income's been. It's been paid monthly, it's been consistent, and you can see there it's been substantially over the benchmark, the light blue, at each period. And so I'll just pass over to Don to summarise before we open up for a few questions.
Yeah, so just summarising the outlook, we expect interest rates to remain lower for longer, and certainly that's what the market's forecasting here in Australia. Potentially we could see interest rates here in Australia, cash rates at 0.5%, possibly even lower in the next 12 months, although we don't believe the RBA will cut this afternoon. We're still seeing some fairly significant increase in dividends, both domestically and globally, although the pace has slowed a little bit from over the last couple of years. We've seen very strong growth, but there was still reasonable growth there, and clearly we have a very strong track record of delivering high levels of income, so 6% in global and 9% plus in domestic, including franking credits in our income funds. So with that, I'll hand back to Mark, and we'll see if there's any questions that we can answer.
Don, Dan, look, always great to hear your views on income investing for low-tax investors. And as the guys mentioned, all attendees have got the opportunity to ask questions on the internet just by clicking that questions tab that you can hopefully see on your screen. While we wait for some questions to come in, Don, I'll just reiterate a couple of points on Plato. Look, Plato's approach is specifically designed for retirees delivering high income in Australian and global equities. And Plato has delivered over 16% gross income in Australian equities over the last 12 months. And in global equities, we've been able to deliver around 6% income in global equities, which is a traditionally low-yielding asset class that Dan was talking about before. Look, and finally, Plato have a long history of delivering consistent, reliable income. The team has won Fund Manager of the Year awards and have got positive research ratings from the likes of Longsec and Zenith. So let's kick off with a couple of questions that have come in. With competition within telcos dropping and Telstra stripping out costs, what's the outlook for its dividend? Probably one for you, Don.
Yeah. Look, I mean, short term, the momentum has actually been pretty good in its sort of mobile business for Telstra. So we've actually seen its price come back a little bit. In fact, we were a little bit overweight actually recently. But longer term, as those NBN payments drop off, we do believe that Telstra will probably drop the special that it's been paying for the last couple of years. Now, even including the special, if actually right now, if you include the ordinary dividend that it's paying and the special dividend that it's paying on an annualised basis, Telstra has cut its dividends 48% from 2 years ago. If you take out the current special level, Telstra's dividend will be 68% lower than where it was 2 years ago. So we do expect that special to slowly drop off over the next couple of years. But right now, it's doing quite well in the mobile business.
Okay, guys, another question on telcos, and more specifically global telcos. Do they have a similar outlook to Telstra in terms of growth and income?
Yeah, thanks, Mark. There's a lot of exciting opportunities in the space with 5G, increased speed, decreased cost, and we'll think that they're often really well positioned to see those developments in autonomous cars, medical and smart homes and things like that, where we see a lot of growth for telcos. I think specifically in income, which is often why a lot of people hold Telstra, there's some really high yielders globally. You got huge companies like AT&T in the US doing 6%, Spark in New Zealand over 6%. Across Europe, Scandinavia, we've got Telenor in Norway, Telia in Sweden, kind of just under and just over 5% respectively. With regards to growth, if we compare it to a broad index, so the Bloomberg World Telco, over the last 5 years, Telstra's pretty flat. And actually that index is up over 50%. But then you've also got to see over the last year, Telstra's been pretty strong and pulled back and actually outperformed that index. So I think we'd advocate diversification and kind of against that concentration risk. Global gives you that diversification away from single names, depending on what kind of time period you're looking at.
I might just add, I mean, the issue for Telstra versus, because the growth in mobile use, etc., is a worldwide thing, and that will benefit Telstra, but it has competition here. But the thing that's dragging Telstra down and not other global mobile companies is that they don't have an NBN issue where Telstra is being forced to sell the copper wire to the NBN. It's treating those sales as profit, but really they're selling an asset that once they sold it, they can't resell it. And so that makes us profit in the short term, but when that falls, when all those sales are finished, there's a hole in Telstra's earnings, and that's why Telstra's a bit different to other global mobile companies.
Good answer, guys. What overseas sectors are paying strong, sustainable income?
Yeah, if you look at Q2, the period we've just gone through, I mean, dividends rose across all sectors, with the exception of telcos. Consumer discretionary was the one that had kind of the most substantial increase. That was actually up over 14%, and this is obviously comparing to previous corresponding quarter to keep things comparable. Financials really continues to be the dominant in dollar terms. That paid out 165 billion in Q2 alone, so paying about a quarter of that overall yield. But one thing for us, Mark, as you know, is that we're constrained versus the index. So although we tend to be overweight those sectors that pay a bit more yield, like the financials, utilities, REITs, and underweight things like IT, we do have a sort of prevent concentration risk by staying constrained to the overall MSCI sector exposures.
Okay, another question on global. Is there cyclicality in global income, and does this impact any distributions that clients would receive?
Yeah, we definitely see cyclicality, as we pointed to earlier. Q2 is a big payer, but as you noticed on that chart where we split out the monthly income, There is a bit of cyclicality. We've paid a bit more in the last 3 months, but we want to keep it relatively consistent. We've had some fantastic feedback from clients who love monthly income from our listed domestic or our kind of global funds. But we want to make sure we're not just paying really erratic levels, so very, very high month and then kind of nothing for a couple of months. So we do keep it a little bit of cyclicality as around that Q2, but we try and keep it relatively flat throughout the year.
Okay, look, that's it for the questions. Look, we are getting a lot of interest in global at the moment, and it's great to see some questions come in. As I mentioned, Plato's funds are available on most wrap platforms, and we are favourably reviewed by the likes of Lonsec and Zenith with regards to our research ratings. Our marketing team will be making the webinar available on the Plato Investment website later today. We'd certainly like to thank you for your participation, your questions. If you have any further inquiries, please contact the Plato website, which is www.plato.com, or contact the Pinnacle Distribution team. Thank you for your time. We look forward to speaking with you at our next webinar, in your office or at one of our luncheons. Thank you very much, and have a great day.